And then I'm going to hit Facebook.
Good morning and welcome to the Valley Economic Alliance's Pathway to Profit program, Unlocking the Power of Receivables. I'm Sonia Blake, and I am super excited to welcome you all to our program today. We have a wonderful facilitator and a phenomenal speaker who are going to talk about a subject that's very important, especially these days. You know, we've been through a lot over the past couple of years, haven't we? We've been through a lot. And there has been some support for businesses, but not enough. The need has been much greater. And now that a time is passing, there are not as many grants available, and folks who have gotten some of the emergency loan funding are leveraged and they don't necessarily want to do more of that. We really want to go into getting customers and finding alternative ways to finance our business growth, so that we can grow, create jobs, and really recover and impact the economy in a very positive way. So we at the Alliance have been working with organizations, especially based in our geographic region, for almost 30 years. And the Valley Economic Alliance was founded like a phoenix rising out of tragedy. The Northridge earthquake in 1994 was kind of the birth and the inception of the Alliance, because there needed to be a community convener that would bring together all of our stakeholders, whether they be our government officials, our nonprofit leaders, or our industry, our small businesses, and our major corporations. Come together, receive FEMA money, dispatch that to wherever it needed to go, connect the dots, connect our community, and help us to recover. And wouldn't you know, the Alliance is still here today doing that work, whether it's emergency times like now, or it's just calm and peaceful times, but companies want to grow and job seekers want to find job opportunities and vocational training opportunities, and residents want to have a great quality of life. So that's what the Alliance is about, and we're very excited about presenting our Business Assistance Program, where we help companies to get the information and resources they need to start and grow and thrive right here in the San Fernando Valley. One of the greatest assets of the Alliance is our team. I want to thank Erica, our excellent facilitator of our technology today, and Brett Dickstein, our business advisor. I'm going to introduce Brett, who's going to introduce our phenomenal presenter today, and then we'll go ahead and get started. Brett Dickstein, who is a man on a mission. He's got a heart and a mind for small businesses, for businesses. He's been working on economic development and workforce development and small business development for such a long time. Beginning in the corporate world with companies like PricewaterhouseCoopers, IBM, UBS, HSBC Bank, Brett has expanded to overseas arenas and workplaces, and after graduating from CIPA at Columbia University, he spent over a decade as a technical assistance provider for international governments, development agencies, and the private sector in emerging and frontier markets. We're so proud to have him on our team, and he has deployed millions of dollars to businesses seeking to recover in the wake of the economic downturn triggered by the COVID-19 pandemic. So I'm really pleased and thrilled to share with you our gem, Brett Dickstein. Brett, take it away.
Thanks so much, Sonia. And thanks to everyone for being here. Good morning. In a nutshell, I've had my entrepreneurial endeavors, and I've started and co-founded, small companies, restaurants, small service businesses. My family is very entrepreneurial, and friends as well. So I've kind of dabbled in a lot of businesses, even startups and early stage companies. And from that experience, I have a consulting company. So I've been trying to share knowledge as I learn it. And I gain it. I try to bring in people that also have a lot of experience working with small businesses and just kind of having that firsthand experience in the weeds. So I thought that this workshop was, very timely, because we have been working with businesses on all of the disaster financing, for the last couple of years. It's been really tough getting through the pandemic for so many companies. And there has obviously been a lot of funding flowing from the federal and state government. There's been a lot of grants, there's been a lot of disaster loans, and a lot of you got them. And Some of you have used them to make them work for your business, and some of you are sitting on it, and some of you have spent it already just for paying the bills. So it's totally understandable. But what I've noticed is over the last year or so, a lot of companies, if they want to grow and they don't want a term loan, they want something alternative than that, and maybe not a line of credit or a credit card, but they have needs such as trying to pay staff or hiring more staff. And maybe they have a service that they get paid by their vendors or partners 30, 60, 90 days later. And they're waiting sometimes for months, and they need the cash to pay their staff. Or they have purchase orders and they want to put in a manufacturing order, and they need the financing, to meet those contracts, so then they can turn around and sell it and make a profit. And with all of the hurdles in the transportation industry and the increases in cost of transportation and fees and duties and tariffs, it's really made it difficult. So cash flow management has been a real challenge for businesses. But the ones that are really trying to get unique and creative are the ones that are using services like our guest speaker, Andrew Krone, offers. And I thought it was really timely to have someone come in that's just been doing this for years. So I want to introduce Andrew. He's got 40 years of experience in business finance, working in sales, cash management, product distribution, marketing, purchasing, manufacturing. He's been a U.S. Small Business Administration mentor and loan committee member of the Northern California Small Business Financial Development Corporation, and he creates financial solutions for small, medium businesses. And we're pleased to have him here to share his extensive knowledge with our community. And I think he really is a strong educator as well as a provider of financial solutions. So Andrew, with that, I want to welcome you. And I want you to please feel free to introduce yourself as well as Marble Bridge Funding. And the first question is, please also share with us the types of funding programs that you focus on. Thanks.
Okay. Thank you, Brad, and thank you, Sonia and the BEA for inviting me to speak today, and for all you that are in the Valley. Just so you know, even though I'm up in Northern California, I grew up in Northridge, so I'm a true Valley boy. Used to cruise Van Nuys Boulevard when I was a kid many, many years ago. Don't know that if they do that anymore. I was there for the Sylmar quake. I was there for the Northridge quake. So I'm very familiar with San Fernando Valley, the Valley in general, and just want you to know that grew up and was raised there. Marble Bridge Funding Group, let me introduce the company. We are a commercial finance company. By classification, we are licensed by the state of California. We are a direct lender. We are not a middleman. We've been around 23 years, going on 24 years, and I've been here 21 years, but I was there when we were first formulating the name of the company and getting started in the marketplace, and joined about 21 years ago, going on my 22nd year. And as a direct lender, we specialize in accounts receivable finance, purchase order finance, and contract finance. And then along with that, with all the years I've been doing this, I have a tremendous amount of information on general finance. I work with all different types of lenders, including the SBA. I work with SBDC consultants, BEA. So I work with the nonprofit lenders. I know a couple thousand bankers. I know VCs, angels, all different types of contacts that you get familiar with in this funding arena. And so I'm a wealth of knowledge at that end. At the very beginning of the chat, I put my email, just so you know, and my phone number. So if you'd like to follow up sometime afterwards, feel free to reach out to me. I'm usually pretty good within that day or within 24 hours of getting back to you, so you won't be hanging on there. And we'd be glad to help you in any way I can on any advice, even if it's not what the topic is today. The goal is we need to help small business. You drive the engine of the economy, and we want to do all we can to help. So that's a little bit about Marble Bridge, and Brett's giving you a little bit of information about myself. And so the first thing to talk about, and this is going to be sort of a deep dive, something you would never get from traditional lenders. So we're going to talk about what we do. So accounts receivable finance. So this webinar is geared to businesses who provide a product or a service to another business or to a government agency. And in all those cases, when you're in that type of business model, you generally don't get paid right away or get paid up front. Sometimes you can get parts of it, but generally you don't. So everybody in traditional American finance and being a small business, you've become a bank. You basically are providing a product or service, then you have to give terms, whether it's net 30, as Brett said, net 60, net 90. And though I can't see all of your faces on this webinar, I know I'll get a few smiles. Some of you may even have net never terms. Anyone ever heard of that? Would they never pay? You know, so things happen when you're a small business, but in order to go after that type of business, you have to do receivables. What people don't realize is if you're a $1 million business, and if you did $1 million last year, and you divide that by 10 or divide it by 12, you're basically invoicing around 80, 85,000 a month. The average business, and I've been doing this for, like I said, 21 years, whether you're in construction, whether you're services, whether you're staffing, whether you're in manufacturing, the average business gets paid in 60 days. So if you do the math on that, that means you're carrying receivables of 160,000, all right, 160,000. Now, that's money that's not in your pocket. That's if you shut the doors today and you collected it all, 160 would come your way. So when you grow your business, your ARs are going to grow. So if you're successful at growing it, the problem isn't sometimes, you know, getting clients, growing your business. The problem is carrying the receivables. What happens if you go from 1 million to 2 million? Your receivables aren't 160, they're 320. The average business, and I'll just give you just my insight, who does $1 million, they make 100,000 profit at the end of the year, 10%. That's a pretty good number to reference. If you're making more than that, you're doing better. If you're making less than that, you're doing worse. But if you have $100,000 profit and you don't take it as salary, and you go from 1 million to 2 million, how are you going to carry receivables now from 160 to 320? You can't do it. Can't be done. So receivable financing, what we do, we lend on those receivables. We convert them to cash. And businesses who we work with, you know, and this will come a little bit later, is everybody you can imagine in retail, wholesale, manufacturing, government agencies. They all work with our industry. It's $1 trillion industry worldwide. It's a major layer of finance underneath banks. Okay, so receivable finance and real simple, 80% advance. So if you had a $100 invoice, $80 wired to your bank account. You had a $1 million invoice, $800,000 wired to your bank account. So we can get you the cash fast. And what if you had the cash fast? You could hire more people, pay your suppliers early. There's all sorts of things you could do, but what you can do with this type of financing that virtually nothing else allows you to do is grow extremely fast. And we'll come into stories about that a little bit later. Now, as Brett alluded to, there's also PO finance. So PO finance stands for purchase order finance. So it's very simply stated at, you know, you got a food product, you're selling Whole Foods, right? And Whole Foods gives you an order for $200,000 to give them a power bar or something of that nature, whatever the product is. The problem is you don't have the money to either manufacture it yourself or pay the third party who's making the goods for you to manufacture it. So PO finance, which is pretty rare in the US, I've been at it a lot of years. There's very few companies that offer that. So receivable finance is more common. PO is pretty rare, and everybody does it differently. There are a million different ways to do it, but PO would mean in Marble Bridge's box that we could advance up to 75%. So if you have a $100,000 order, we could advance up to $75,000. You're going to take that money, and if that's your cost of goods, you're going to go ahead and pay the third party to make the goods for you. And then eventually those goods get done. They ship over to your client, and then it becomes an invoice. So PO finance is a bridge. It's sort of pre-bridge. Different qualifications to get it. It's higher risk because we're acting like a mini angel or VC. So there's more of an analysis. But I've had plenty of companies that I've done PO with over the years that we've been in business, and it's very successful. And if it really helps you grow, what happens is eventually you don't need PO anymore. You're back to AR. Okay. And so that's that. Contract finance is similar to PO, but slightly different. Contract finance you'll see a lot in software companies. So software companies who provide a license agreement maybe once a year to a corporation may also have a maintenance agreement monthly. And so every month they agree to bill out $10,000 a month that they're going to bill out the client. And so if we funded the ARs, which are less expensive than POs or contracts as far as costs go, and now they need even more money to fill more orders, we might be able to do contract finance where we're funding 30 or 60 days in advance of that invoice going out the door. So again, it's like PO, they haven't delivered yet, but they have a solid contract, they have strong clients, they have good background themselves personally, and you can figure out the risk and how to do that. So we also offer PO and contract finance. And within these three products, companies sometimes get into a rut. So small businesses, say, all right, well, I do all the work and I bill my client at the end of the month. Well, why? Well, because that's what I do. And so they invoice once a month. Well, talking with me and analyzing your business, there may be a way to speed up your cash flow. What if you can bill weekly? So someone may say, well, if I bill weekly, they're not going to pay me at the end of the month. They're going to wait till the end of the month and pay 30 days later. So what? So what? Bill weekly. If they'll allow you to do it, I could fund you weekly. You can grow even faster. So there's different tricks of the trade. It's not so transparent of I got AR, how do I get money? How does that work? You need an expert to tell you, to look at your business, hear how you're running it, and get the feedback back on what you can do to speed up cash flow so you can grow even faster. So that's part of the service aspect along with the products that we offer the client at that end. So that's a short coverage to that question, Brett.
All right, super. Thanks for being so thorough. So now we have a good sense of some of the types of financing. In some cases, some of this is also, another term is factoring for some of this type of financing. So I see some questions coming in, so we're going to save those towards the end, but we'll get to them. But can you just give us, Andrew, a little idea of the type of profile of the business that you typically would fund in terms of, their revenues or the kinds of contracts they have, as well as kind of a two-part question. What does it take for that kind of business to get funded with your organization, and what kind of credit score do they need? Do they have to, can you fund pre-revenue or startup businesses? Do they need collateral, other requirements?
Okay, so that's a very good question. So if, been doing this 21 years, so let me just see if I can give you the types of businesses I've run into. I've run into businesses that are software companies. A lot of them need financing. On the other side, computer hardware companies. I've done a ton of janitorial, which in this COVID environment is an exploding business right now because they can't get enough people to do the job, to do the deep cleaning. And so there's huge growth in that category. I have companies that have made food for Whole Foods. And so I've done organic food companies. I have engineers. I have architects that I've had in my portfolio. Truckers. As you know, there's a shortage of truckers in the US. Anyone who can get into that business and get the trucks and get them on the road, meet the qualifications. I have companies that have grown tremendously in the trucking industry, and they get paid very slow. So they constantly seek out my type of financing to cover the slow pays because they got to make payroll weekly. So you see truckers, you see contractors. So the construction business is really having some challenges now with COVID running around and trying to get jobs done. But contractors, subcontractors, if you understand construction, they have to work 30 days before they can bill. They have to make payroll before they get to the end of 30 days several times. Then they bill, and then they don't get paid for another 30 to 60 days. So we do a lot of contractors in California. I got one that's involved with high-speed rail right now, as an example. Any of you been to Home Depot, just to give you an idea of a client that I know you've seen indirectly, and you had you scan yourself at the register at Home Depot to check out? When they put those scanners in, I'm the guy who funded that company who put those in all the Home Depots nationally. So you may have not heard of Marble Bridge, but we're all over the place. We're helping high-speed rail. We've helped Home Depot, all sorts of different types of products, houseware products, medical device companies, people helping with mental illness, people in the medical industry, anyone that's basically receivable based.
Right.
provides a product or a service. Now, the second half of that is the type of profile and company we get into. Typically, companies, so, from a range, I could tell you this, I have signed clients that are pre-revenue. And when you go for a bank line, they want to see you 2 years after you've been in business. Pre-revenue means that in the next 30 to 90 days, they are going to have receivables. And so they know they can't get bank financing and they want to get set up with me. So it's very easy. How do I say no if there's no history about your financial situation? So we've signed companies that are going to use us within 30, 60 days. Quick example, I got 3 gentlemen, they're partners. They all have their own businesses, totally different. They're starting a staffing company for janitorial.
Mhm.
And they got contracts and they're ready to go. And they want to sign up so they can use the receivables to help fund the payroll. So they have the initial money to make payroll, then they invoice, and then they'll be using my money to cover the next set of payrolls. And then they can grow very fast from that end. So we work with startups and we work with companies that are up to 50 million a year in revenue. But to be honest with you, in the world of small business,
Mhm.
most of the clients we see are running a couple $100,000 a year in revenue up to 20 million a year in revenue. And all these companies have something in common. They all have the ability to grow fast. They're not just growing at 2% a year because a bank line can cover that type of growth.
Mhm.
But the reality is they have the ability to grow fast, or they've had other issues during this economic downturn and some of the challenge involved where traditional banking may not work. And we'll get a little bit more into types of funding.
Okay. So if the financing solution might work for a company, what range of funding can you actually provide on a monthly basis or a weekly basis?
So, I mentioned that. So we have no minimum requirement at Marble Bridge. So we don't fund, you do. You have one invoice, you have 50 invoices. You decide when you need the money and when you want to use it. So there's no minimum on that side of the scale. And we have the ability to fund up to 5 million a month. And I've been here, all the years I've been here, nobody has ever borrowed 5 million. But I've had people borrow 4 million, 3 million, 2 million, 100,000, 30,000, 5,000. It just depends on what they want to get. So there's no minimums. One month you may have great cash and you're good to go. Next month, nobody paid their bills. And you're like, all right, I don't want to have no sleep. I want to make sure I have it covered, so they'll fund with us. But the reason why you would go with us is because you have the ability to grow in other doors of finance, banking, SBA loans, family, friends, Visa, MasterCard, home equity, giving up equity in your company, other types of ways aren't quite the right fit.
It reminds me just of a company that Andrew and I had worked on together. The company won a contract with a large school district in LA County, and they were looking to staff a lot of cleaners for the schools. This was all happening during the pandemic. And the contract said, pretty much you can have thousands of employees because you can get all the schools. If you can staff the employees and pay them, then that work is yours. So I think Andrew was able to put a solution together for that company where, he's been financing, I think over $1 million a month to be able to pay, these businesses, this business, so he can afford to pay his cleaners for these schools. So it really is an interesting solution. But how does that kind of funding that you offer, AR, factoring, contract, PO financing, how does that compare or differ from, a business credit card or a conventional line of credit from a bank, or an SBA microloan or some other term loan?
All right, so this is through my magnifying glass of the years I've been doing this. So I'm giving you my personal opinion because I've worked with thousands of bankers who referred me clients. I get to hear why they've said no. So let's just talk about traditional banking. So traditional banking, the most common thing you'll hear is a line of credit. What you won't hear is how that's determined. And different banks have different programs. So this doesn't mean it's, but I'll give you sort of a general viewpoint. So for those of you who are getting in business or sort of frustrated with the banks, you should know how they're thinking before you go in. So generally speaking, banks want 2 years of business. Some may be less, but usually 2 years. They want profitability. They don't want to see losses. So no losses for those 2 years. Okay. They want to have secondary source. So they're looking if you have equity in your home or equity in a business, or you have 3 other businesses that's pulling in money, or, there's other money coming in, that can come in to help mitigate the bank. But the key thing is banks lend off previous year revenue. So what do I mean by that? So if you did $1 million in revenue, all right, and you're going to go to 2 million, they're not going to give you the money to get to 2 million, not on a conventional line. They got to do it on past history. Otherwise, all of you be running to a bank and say, hey, next year I'm doing 5 million, give me $1 million to get there. And they'd all do it, and I wouldn't be here today. So it doesn't work that way. So with banks, they give you, if you do have a line with credit, and some of you probably do in the listening audience today, it's typically about 10% of previous year's revenue, plus or minus. Plus might be because you have 3 other businesses, or you have millions in the bank and they can give you more. Less if you don't own a home, or they gave you the line because the business is good, but you have no secondary. So if you're $1 million business, and I talked about this example earlier, you might have a $100,000 line of credit. If you're $1 million AR business, you have 180,000 in receivables. So that means the bank line is all sitting in your receivables. Now you go to your bank, and it's very common. I see this all the time. And I'll give you an example earlier. You go, all right, I'm going to 2 million next year. I got all these contracts. I need another 100,000. And the banker will say, call me when you get there. And you're like, but I need the money because my ARs are going to go from 180 to 360. It's not going to happen. So banks are usually for conventional lines or for slow growth. SBA loans are, a godsend to, a lot of small business, because they're designed to lend to businesses that generally aren't strong enough for a conventional line of credit. And if you get the 7A loans, if you have a home with equity, and almost everyone has a home today, generally has equity in their home, 7A loans, for the most part, require a deed on property, and banks will take those. So they'll take that as the extra collateral. But the loans could be larger than a 10% line of credit from a bank, but they're term loans. So think of them like a mortgage. When you get the money, you get it all at once. You may not need it all. So you're paying interest on money you don't need, potentially, and you have that 7A loan. And when you spend all the money on working equipment, on marketing, on carrying your ARs, again, once you're $1 million business and you have a 200,000 SBA loan, and you're now at $1 million and your ARs are 180, there's no more money. You've used it all. It's all deployed, and now you have a term loan over 9 years. And so the idea is, how do you grow once you have everything deployed? Because it's usually hard to get a second SBA loan, which means you have to be able to convince a bank to give you a larger loan, and it becomes more challenging again. So that's where the SBA loans, the micro loans, the mini loans for 50, 100, 150, those are good loans for smaller businesses, again, to get them growing, but they will all, if they grow, they will all deploy that money at some point, and then they're looking for more money to grow. You also have, if you're in small business, I know you're familiar with this, you've been hit up 1 million times by flyers, by emails, for what I like to call the
payday loans.
or the nice term, or vulture capital.
Yeah.
Not nice term. And those guys are the ones that say, hey, I'll give you 100,000, I'll put it in the bank, and I get to take it out every day or every week out of your bank account. It's 20% interest or 18% paid back in 9 months. Well, that could be all the profit you make. So if you only make it 20% on every receivable you have, you're not going to ever get out of it. You're going to be stuck in that role. And it's buried a lot of businesses. It probably helps some businesses, I'm sure it has, but a lot of them have suffered by taking high interest loans and not really understanding how to get underneath it and how to get out of it. So the one thing I want you to know and take away from today's meeting, for those of you that have 7A loans and also have the nonprofit SBA loans, you should be talking to me if you need more cash. And you should be talking to me to learn how we can work together, because there are lenders that will work with me so we can work together. And 7A loans allow for receivables to be lent to another business. It's the SBA rule. Whether the bank wants to do it, it's another story. But I've done it for years. I've helped clients get more money beyond the SBA loan. So if you have SBA loans or state guarantee loans, of those type, they're term loans with guarantees from the SBA, you should be talking to me just to understand how that works. And by talking to me, I can give you feedback, why it can happen or why it can't, and give you some ideas and suggestions. So there is a way to get more money than just from Marble Bridge or from.
Andrew, could you just dig into one thing? So the payday loans, you know, a lot of businesses do get those advertisements. You know, you take some financing, you need it quick, you get it quick. You know, they don't go through all the major, you know, loan documentation review. It doesn't take months. You get it really fast, but it costs a lot of money, and people don't realize that, yeah, they're starting to take out, you know, some of the funding every week, or sometimes daily, you know, from what you're making. So how is this different and more affordable, the kind of services and financial solutions you offer, versus some of those? How what does it cost, I guess, is kind of the.
Well, receivable financing really isn't debt financing, because you fund an invoice and then it pays. So when it pays back, you owe me zero. So you're never carrying debt like the fintech loans where you get 200,000 and it's on your books and it looks great day one, but every day it's like getting stabbed in the chest when they take out $3,000 or $2,000 or $5,000. And then what happens is there's a point where your money was deployed. And if it wasn't deployed efficiently, where you made profit to afford the loan, what I see happen over and over, you have to renew the loan again. Or you run to another fintech lender who you're using to pay off the other guy. You know, I've seen, they call this stacking in the industry, and you get more and more of these loans. And I believe it or not, I saw janitorial service with 10 of them, 10 of them. And I could tell you the contracts, he violated every contract. The requirements of only having one lender, they didn't care, but they gave him the money, and he was headed towards bankruptcy. There was no way out.
So I know you've done some creative things where if people actually have some of those, you call them fintech loans, payday loans, whatever you want to call it. If people have a loan already, and sometimes they have multiple and they start getting in over their head, your organization actually can take out some of those loans, right? If they qualify for the kind of financing you offer, you might come in and help them remove some of that type of financing they have, so they start kind of fresh, right?
Oh, well, when you're looking at it, I have one right now I'm looking at. They have a bank SBA loan, and then they got in trouble and got a fintech loan, which violates the SBA loan requirements, which they didn't understand. I'm explaining. But so the goal is, if you have fintechs, we want them gone because they're just draining your cash every day. And so if there's receivables, which they don't fund, I could fund receivables to pay them off. Or I can work with the fintech company and sometimes work with them when they're liens to let us get in front of them. A lot of them will do that. And there's a whole story about liens and how that works and how I do it. But I've negotiated that. There's all different sort of what I call trade secrets, at least how we operate, and to help you out of those. The key is how deep you're in, what's going on in the business. Right. And again, replacing, you know, financing with financing. What you want, you know, you want to save money because that's what the people, oh, it's too expensive. Now I realize it's a mistake. I want out. You know, my financing is a cost of goods sold because my financing is linked to each invoice. So you have to look at your margins, what you have going on, what the growth is, what the competition is like. And I can educate you a little bit on how to deal with that. But if it's possible, we'll either get the fintechs to move out of the way to let us in because they want to do that and they really don't care if they let in another lender. But my goal is to get rid of them. There may be ways to negotiate an early payoff so you don't have to pay it all off, because all they want is get the money out, get it back, make some profit, and get it out to the next business.
Okay, super. Thanks for that answer. So the next question I had actually coincides with a question that one of our participants actually has as well. Are you able to fund companies that have, you know, some challenges with, you know, credit, maybe a past bankruptcy, maybe just late payments over the last couple of years that have really kind of brought their credit score down, current judgments, tax liens? Can you work with those kind of companies?
Yeah, in the form of underwriting, as far as traditional bank SBA loans and loans of that nature, we have the most liberal underwriting out. What I am looking at is your business. And so I have businesses that come in that, had a loss last year. So, the banks would usually say no. I'm saying, why did you have a loss? Well, it could have been a one-time event. It could have been something, a bad contract, but everything's good now. So I have the lowest bar. You can walk over my bar where you got to do a high jump over a bank bar to get a line of credit. So I have the easiest line. So I look at past history and, understand your explanations, but I'm looking at where are you now? Where are you headed in the future? So I brought on a company that has 3 years of losses. There's good explanation, but this is the year that everything is going to change. We sign them up. Credit scores, I have people with 800 credit scores, and I have people with 500 credit scores. Again, when I look at the credit score, what happened? I got a divorce. I had this happen, medical, there's all sorts of reasons why people suffer on their personal credit. So we do look at that. We do pull the credit, but the decision isn't credit score based. It's business based. That's what you want. You want somebody who wants to understand your business. Right. What happened? What's changed? I mean, we've had COVID. There's been a lot of different things, but I've been doing this 21 years. During the housing collapse, during the tech collapse, during 9/11. I mean, we've seen businesses in all sorts of types of conditions. The reason why we are talking is you can tell me and show me I'm going to grow this business and I need your help to do it. And that's what we're looking at. Now, you have a judgment, okay, and that shows up. That lien, if I fund you money, the people at the judgment can come after us for the money. So judgments are a problem. But again, if you can negotiate with somebody who has a judgment and get an agreement in play or pay it off half in your funding, they'll usually will do that. And then we'll monitor to make sure you pay it down. And then they don't get in the way of us funding you. If you have tax liens, business tax liens, the IRS does allow for subordination and does allow for my company in to fund you, but it depends on how much you owe, what the history is. Hopefully you're staying current now. Hopefully you have a workout agreement. If you don't, there's a process involved to deal with that to bring you in, but you've done it with this. So I could tell you how it's done.
Okay. So before we dig into just briefly, and we have about 25 minutes left. So before we kind of briefly dig into how AR, PO, and contract financing works and how much it actually costs, and getting a few examples from you, can you just tell us briefly why a client might actually get declined from like an organization like yours? And also, you kind of mentioned the pandemic. How has COVID-19 and the pandemic kind of affected, your business funding?
So COVID-19 hasn't affected our underwriting. It's had zero effect. I know the banks and SBA rules, they dive in now and they want to get a whole story on that. It's not critical with us, right? What I look at is where your business is and where it's headed. And I'm trying to make sure we're the right fit for you. And I got to show you that, and you got to see it yourself. So if we're both in agreement, we're going to go forward. When you're talking about declines, we're no different than a bank. We do background checks. We check with the IRS. We do everything a bank does. So as banks would always tell you, tell us everything that's going on, personal, business, anything. We will find it. So I would say since I've been underwriting and doing this for 21 years, I'm at probably 99.5% of all clients I bring in to underwrite get our deals. That's almost perfect. The reason why is I've turned it down ahead of time, because either it's not the right fit and we both agreed to that, or you need someone like Brett to come in to help clean things up. You're not quite ready for us yet. So there's, the SBA, Brett, there's various consultants free, the small business. You want these guys in your back pocket. You want to use them as consultants because it costs you nothing, and they can come in and fix things so we can be ready to go. So we all work as a team. And the ones that I have turned down didn't tell me the truth. I did, credits. I did a background check and I found all these problems that they never, and I get upset because I wasted a lot of time and they had expectations that were never going to be met. And so, but on a year basis, I pretty much am talking to everybody. I'm not like a bank who's looking for ratios. I'm looking to hear your story, understand it, see it in numbers, And that's why we're able to get the deals done. We do business the way you wish everybody did. Hear my story and give me the money because I got a good story to tell. So we want to hear the story and we get it done that way.
All right. Okay. Thank you for that answer. So another question is just maybe you could break down how this kind of financing actually works and what are the costs involved.
All right. So this is going to be a very simplistic mathematical model. So nothing on screen, but I'm sure all you can understand it. So receivable finance, and there's 1,800 companies out there that do this. So I'm giving you from my view, my take, but what's somewhat standard in the industry. And by the way, banks offer receivable finance as well, but they usually offer it to companies that are much larger, 10, 20, 30, 40 million, and they have a lot more restrictions. As an example, they won't fund government receivables, we will. So we're the most liberal on all those types of ends, but let's just make it easy. So what is the cost? So as you know, interest rates have come way down. Of course, you have a savings account that they don't pay anything on at the bank anymore. So everything's been sort of compressed. Our industry's been compressed as well. So when I mentioned to you a cost of goods sold, I'm not going to say this is your rate, but I want to do this math-wise so you at least have something to gauge. And then when we talk separately, if you have interest, we can dive into it. But cost of goods sold means that our industry makes money off each invoice you decide to fund, and we make a percentage. So let me give you an example, because I also used to be a department store buyer many gray hairs ago. And so at that level, when I was a buyer, a vendor would come in and try to sell me. And after we had negotiated a price for his merchandise, I used to say, can I get a better discount if I pay you, can I get 2% off your $100 invoice if I pay you in 10 days? So in retail terms, you call that 2% net 10. So you're willing to give up 2% of your profit to get your cash faster. It sounds like what I'm doing, but the math on that over 30 days means you're giving up 6%, 2 plus 2 plus 2, all right, in order to get 10 days early. Receivable finance is that concept. We get a discount off the face value invoice. So let's pretend the rate is 2% for sake of argument. So if you had a $100 invoice, here's how the math goes. Let's say, where are we here? We're in going into February. Let's say March 1st, you give me an invoice for $100, then I do my magic, my due diligence, and there's a process that we're not going to deep dive in today. That's when you get to know me. I'll teach you how it works. But let's say that same day we wire you $80. So 80% advance, which is fairly standard among banks and among the industry. It's pretty much the gold standard. You have $80, we have a piece of paper that's worth $100 in invoice. 30 days later, your client pays. If you had a bank AR line, you would have what the banks call a lockbox. The money would have gone to the bank. You're working with Marble Bridge, the payment would have gone to Marble Bridge. So, and we can go into how that works, and there's exceptions and things, but to give you an idea. So we received $100. That's how we get paid back the $80. That leaves $20 left. Of the $20 on a 30-day invoice, I use 2% as an example. We're going to take 2%. There's $18 left. And in theory, that is wired back to you. And we only wire the money to you. We don't send you checks. So it's wired that day. So you got 80 up front to do what you needed to do, to make payroll, pay rent, do all the things you need to do, hire more people. We collected 100. We paid ourselves the 80. There's 20 left. They took our $2. Then you got the $18 back. So you basically got your 98. You gave up 2, and then you owe me nothing. So all of you know, just to make a point here, we are in an inflationary environment. When I see In-N-Out Burger paying $13 an hour and then a year later paying $21 an hour, that's crazy. And we can all see it in our food budget. Go to a restaurant, $12 for a salad with no chicken on it. I mean, it's lettuce, but the labor is going up, costs are going up. All my businesses are being forced to raise prices, all of you. And nobody's going to fight you this time because everybody's raising their prices across the board. I am a cost of goods sold number. So if you are bidding on a job and it's a $100 job and your cost is $30, If you got Marble Bridge in there, you should really be charging $32 because they want you to be a bank, right? They're not going to give you the money right away. They want you to hold, spend your money, and then they hold your money and they're getting interest or doing things with it. So my clients in this environment, it's never been so easy to load our costs into their costs. And then you don't care. In fact, you're bidding on a job and everyone's net 30. What if you bid on a job for net 60? I'll give you 60 days. Then all your competitors can't handle that. You win the job. And if you want to cover my costs, put in 4%. A lot of the clients want the terms. They don't want the discount from you, right? And you don't want to offer your client a discount to pay early. That sounds like you're desperate, number one. And it also means that you open up that door, it's hard to shut that door. As a department store buyer, when I learn I can get two, I can get two. And I would get it every time from my clients because it would be well worth it for us. So, it shows strength at that end. And that's sort of a quick overview on AR. PO is a little different, just to jump on that, Brett, that's quickly. Usually, a lot of companies only want to give you the cost. So if you have a $100 invoice and your cost was 50, they give you 50. We would give you 75, up to 75 or 75% advance. So we're usually better than most of the PO guys who give you more money to work with. But you will have a PO cost because, we've given you the money early and it costs more than the AR cost. So you might add another point or 1.5 points to that, maybe, just depends. And then it converts to an AR and you're going to have a couple of points on that if it's 30 days. So when I do PO, you got to have margins. You can't be really slim margins when you only make 5% your bottom line. It doesn't work. So, there are a lot of this software companies make 80% on their software. They could easily afford that. So you got to look at it, and that's where my expertise comes in to see how your business model is working and how to make that work. But PO, same way, except a PO converts to an AR. So there's a PO rate, and then there's an AR rate, and then we're paid back, and then we're done again.
Okay. All right. Super. We're down to around the last a little more than 10 minutes, and I wanted to get to a couple questions that we've got in the chat.
Before we could do that, I want to give one story.
Oh, yeah, please.
Because you guys got to hear this, all right? So this is to us that's doing about $5 million a year. They have an SBA loan. They're growing. They had a concentration risk, meaning their major client was Tesla, all right? And they had an SBA loan for $500,000. So as you know, that 10% rule, right? 5 million in revenue, 500,000 SBA loan. That's great. So what happens is, this is before Trump was elected, Tesla, for this client, froze all orders for 90 days before the election. So the client had no revenue because the majority of the business was Tesla, and they took a loss at the end of the year. But after Trump got in, the company said, hey, I know we've done several million a year with you. We're going to give you 10 million in orders, 10 million for product and for services in 10 months, in 10 months. And based on the numbers, the company would make 3 million profit. However, Tesla said, we want 90 days to pay you. So every month they put out 1 million in invoices. They won't get paid until they put 3 to 4 million out. So they called their bank and they had a meeting. They said, look, we need more money from you because we're going to make all this money from Tesla. So they asked for the bank for more money. So the bank said, we're not going to give you the money because, as I said to you, and they didn't understand this, banks aren't your partner. They're lending you money. They want to get paid back. They don't lend on future projections because you never know what can go wrong. And because they had a loss, they actually wanted their money back, which is the opposite of what the client thought he'd get in the meeting. But the bank said, however, I have a solution. Call Marble Bridge. They'll give you the money. So we paid off the bank and we gave them the money, and we put out $4 million for these guys. And they did not have homes and buildings worth $4 million to cover it otherwise. And in 9 months, they made several $1 million. They love us. They became millionaires.
So it begs the question on this particular call, and the small businesses in the valley that we work with. We've got even on this call some consumer goods companies that do B2B and some direct to consumer on their websites. We've got a medical device company. We've got a few mental health businesses that are on here, a few therapists. Would you know, they be looking for this kind of financial solution, or why?
So, you know, from a therapist, I have physical therapist models that provide services to nursing homes, as an example. So their client is a nursing home, so that's B2B. And I funded that guy. He's gone from 2 million to 4 million in revenue. His challenge is finding other therapists to work for him that take on larger jobs. Nursing homes always pay in 90 days because they're getting Medicare or Medicaid.
Right.
So it takes them forever to get paid. So they hold off on paying the guy. But yeah, that's a perfect fit. Any of the others, if they're B2B, business to business or business to government, you know, if you're doing that model, we're the guy to talk to. We'll get you way more money than any other source. And it's cheaper than giving up equity by a mile. And it's cheaper than getting bank money if they don't give you enough money, because you're passing on opportunity costs. Give up $1 million in revenue. You don't make another 100,000 when you have your second million. You're going to make 300,000 to the bottom line. A couple, because your overhead won't change that much. So we change people's lives. Average client, 6 months to 2 years. So our job is to get you from point A to point B, bridge you, and then you move on to more traditional finance.
Okay. How about solar companies? We've got a question from the audience, if you've ever worked in solar.
Oh yeah, solar is probably one of the more challenging business models. So in solar, they're installers. So they're working for a solar company and they got to install the homes and they're got to make payroll and they're billing once a month. So that's pretty easy. So if you're working for one of the big solar companies out there and you have invoices, we fund that, you know. If you're, you know, there's rebates and there's other things that go into the solar business model. I can't fund the rebates. You got to get the consumer, you know, the home you're doing it for, to sign off, and then it's got to be inspected. So solar depends on which end of the scale you're on. This saying solar isn't the total answer, but if you're installing it and it's not the homeowner, you're billing, you know, PG&E or SDG, or you're billing someone else or one of the big solar companies. B2B, again, if you have an invoice, you're waiting for it to get paid from the other business, I can work with that.
And it's, okay. All right, so we can put you in touch with one of our participants who might want to dive into that a little bit. So I do have a question from our audience, and it pertains to whether you can do PO financing for crowdfunding orders.
No.
Okay. Okay. Why not?
Well, because there's no AR. You got to keep remembering who is the receivable. Crowdfunding, they get the money, and then, you know, hopefully they spend it wisely and they go ahead and they, you know, can produce the goods. But
yeah, because there's been cases where you might do a Kickstarter, for example, and you raise, you know, a certain amount of money, and you might have discounted the cost of the actual cost to produce the product, because in some cases people do Kickstarters or Indiegogos and they have a manufacturer lined up, but they haven't actually put in an order until they get some orders from these kind of campaigns, and the order might be for a certain amount of money, but then they go back to the manufacturer and it's actually going to cost them a lot more to make it and then bring it in and then distribute it. So
there's a lot
they have a gap in financing.
A lot of issue in that world. You know, if they're close to it, then maybe a small, you know, depending on the dollar amount, maybe a small SBA lender or a nonprofit lender who can see this, see you can make the payments on the loan for 25, 50, 75,000 would probably be a better place to go.
All right. So as I pick the crowd and nudge everyone for the final questions, maybe you can give us a little bit of how you guys are forecasting financing and lending in 2022.
All right, a loaded question. So we can all listen to the Federal Reserve today. They hear how wonderful everything is, and they're going to raise interest rates because things are so good. I think what you're going to see in 2022 is a very challenging economy. If those of you who follow the stock market right now, I think we saw the peak last year. I think there's going to be sort of a change in the market, and you're starting to see that already. I mean, typically, if you're a study of history, when interest rates go up, stocks go down. Stocks go down. How rich does your portfolio feel? You know, how do you feel? How do people feel? I think it's going to be a challenging year. With that, most of the bank stocks are going down. And so you're seeing that. And we're in a very low interest rate environment. I think bank lending is going to be tighter this year, not easier. That's what I think it's going to be. We're going to be busier. In fact, my phones are ringing off the hook. Last year, the biggest lender was the US government. And thank God they came into play. They saved a lot of businesses, from going under. And they saved a lot of bank clients from going under, which helped the banks. But that money is now out there, and some of them survived and they're in great shape. And as Brett alluded to in the very beginning of this, some of you have spent the money, and I'm seeing those clients, they've stayed alive, but now they need more money, and it's going to be more difficult to get it from traditional lending.
Here's that's a good outlook. Thank you for sharing that perspective. I do have another question, and it pertains to whether a business should go to their bank first or simultaneously to see if they offer similar financing versus what your company can offer.
So most of the clients that I get referred in on, and it's all referral from Brett, from SBA, from banks, from CFOs and consultants of all types. The first question I ask when I look at it is, how are you currently financed? So what I'm looking for is, do you have a bank line of credit? If you don't, I'm always going to ask you why. But talking to you also and learning about your business, I could tell you why you don't have it, because it's fairly obvious, as I explained earlier, the basic underwriting of a bank. You got to fit a box. And so it's the highest bar to cross over. So you can talk to me first. And if I think you're bankable, I'm going to tell you. And if you're bankable, I'm going to tell you what I think you can get. And then I'm going to tell you what I can do. Or you can go to a bank, but don't go to 5 banks and do it 5 times. Every bank wants your business. If they can get the business, 1 or 2 say no, you already know the answer.
Okay. All right. So let's see if we have any more. I think that's it. And maybe you could leave us with any tips for our participants about successfully accessing capital down the road.
All right. Well, there's 2 tips, very important. Call Brett, number 1. So, he's a consultant for small business. So them, the SBA, the various government agencies that offer free consulting, use them to help you look at your business and get free consulting. You can't beat the price. Secondly, the biggest thing I see, 95% of the financials are wrong. And some of it is due to operator error. Some of it's due to trusting your bookkeeper. Some of it's due to maybe having the wrong CPA, the way they're presenting the documentation. So, the one thing I do in my business is I will point out all of that, at least from my point of view. I will do everything possible to get your business professionalized at any way I can based on what you present to me and what I see. We only want clients to graduate. Everybody comes in here, I want you to graduate from Marble Bridge. I want you to grow from point A to point B and leave us. We're not like a bank where we try to keep you 10 years. We want you to get to where your goals are and get you out of there. But you got to get your financials in order. And if you don't know better, I will tell you. And I let companies know over and over again, because if you're a business owner, you may be the greatest salesperson, you may have to grow the business, but the biggest downfall of owners over and over again, they don't understand their financials. And that is the biggest thing to success. Know your numbers. But we could bring you in when they're not perfect. I can figure it out and read between the lines, could bring you in. And then in the meantime, you can get those together as a relationship grows. Okay.
All right. Well, I think that about does it. And we're out of time, but I really want to thank you for sharing your knowledge. And as we move forward, if we have anybody that has more questions, we'll make sure that we connect the dots and bring you guys together.
Thank you, Sonia.
Thank you both so much. I want to thank you for that wealth of information, Andrew and Brett. Really great program. I included Andrew's info in the chat again, so you can see that. Reach out to him if you have questions. I put also how you can enroll in our free business assistance program that Andrew mentioned and Brett helps us to operate. There's really quite a few different resources and programs. There's a new grant that just opened on Monday. And if you need help, you don't have to struggle alone. Get help. If you don't need help and you're growing in your business, there are also some events that we do from time to time where you can learn about opportunities. You can meet and network with different influencers and leaders to help you grow still more. So be sure to.
Hi, excuse me, before you get off the phone, I'm on audio. Can you please say the email address? I don't
Oh,
have a chat.
certainly. Thank you so much for saying that. Yeah, the email address is help@economicalliance.org to get more information. Thank you for that. So you can sign up for our
Perfect, thank you.
email list. You can visit our website at thevalley.net. Our next event will be on February 3rd, and we're going to have the governor's office, the California governor's office, talk about tax credits that are available to help businesses save money. And then we're going to have an economic forecast for the San Fernando Valley from an economist at the LA Economic Development Corporation. So you can visit thevalley.net/events for more information about our upcoming programs, committees, and everything else. It is the top of the hour, so we thank you for joining us, and we hope to see you again very soon. Be well and thrive in your business. Thanks so much for joining us. Bye-bye.
Thank you.
Thank
God
you.
bless. Take care.
So
Bye-bye.
awesome, Sonia.
Bye-bye.
Take care.